Good morning and welcome to our live webinar, Fundamentals of Trust, hosted by PKF O'Connor Davies. All attendees are in listen mode only. Before we get started, I'd like to go over a few housekeeping items so you know how to participate in today's call. We've taken a screenshot of the attendee interface and you should see something that looks like this on your own computer desktop in the upper right corner. You will have the opportunity to submit text questions to today's presenters by typing your questions into the questions pane of the control panel. You may send in your questions at any time during the webcast. We have a lot of material to cover, and if time permits, we will make an effort to respond. If we cannot get to your questions, a response will be sent post-event. PowerPoint slides and a recording of today's webinar will be made available to you via email a few hours after the event. At the end of the webinar, we do have a very short survey which will be prompted, and your response is greatly appreciated. At this time, I would like to introduce Christine Pronek, partner in charge of our Trust and Estate practice with PKF O'Connor Davies. Christine?
Thank you, Harleen. Good morning, everyone. I am Christine Pronek. I'm the partner in charge of the Trust and Estate Department here at PKF O'Connor Davies. Thank you for giving us your time today and joining us for our Fundamentals of Trusts webinar. Our speakers today are going to be Donna Perrette, who's a supervisor in our department, and Diane DeMercurio, who's a manager in our department. They're going to be covering multiple topics that fall under the heading of Fundamentals of Trust, but including things such as different types of trusts, a fiduciary accounting income versus taxable income, and then taking it another step to versus distributable net income, and then taxation of trust and some planning ideas. So as Harleen mentioned, we're going to try to get to your questions today if time permits. If not, we will be answering you after the webinar is done. So either way, you will get an answer to your question if it doesn't take place during the actual webinar. So with that, I'm going to pass it off to Donna Perrette to start our presentation.
Thank you, Christine. This first slide talks about the fundamentals of trust, the overview of what we're going to be talking about today. We're going to first be talking about some trust terminology, certain terms that you'll hear us repeat throughout the session, as well as the general trust rules, the types of trusts, fiduciary accounting income versus taxable income, general fiduciary tax rules, such as who's responsible to pay the tax and the tax methods that are allowed, the taxation of trusts, the income tax filing requirements of the trust, the particular forms and deadlines, as well as a 65-day rule, or also known as a 663B election, that can be made by the trustee if it's determined to be advantageous to the trust. Generally speaking, a trust is a separate taxable entity. It's a form of property ownership in which the legal title and the beneficial title are separate. The legal title belongs to the trust itself, where the beneficial title is in the names of the beneficiaries. The grantor or the seller is the person who creates the trust, and that person owned the assets before they were transferred into the trust. The trustee is the administrator or the fiduciary of the trust, and it is outlined who that trustee should be in the trust document, and that trustee is responsible for the management of the assets in accordance with the provisions of the trust document. The beneficiary is entitled to receive the benefits of the trust. There could be two different types of beneficiaries, which we'll talk about on the next slide, income beneficiaries and remainder beneficiaries. In some cases, a beneficiary can be the same person as the trustee. Next slide, please. The principal of the trust is the assets that were acquired by the trust or transferred into the trust upon the creation. You might also hear the term trust corpus. It's the same thing as the principal. The income, however, is the earnings on those assets. There's a variety of the different types of income, but that income is earned by the assets. There are two different types of income associated with the trust: fiduciary accounting income and taxable income, which Diane will discuss later. There are also two different types of beneficiaries, like I just said. The income beneficiary, which is the person who's entitled to any trust income earned, whereas the remainder beneficiary is the person who will eventually receive the corpus of the trust. Just as an example, if a grantor transfers $100,000 into the trust, any income that is earned on that $100,000, either interest or dividends if it's invested, that would be, the income beneficiary would be entitled to receive that income if he's purely an income beneficiary. Whereas the remainder beneficiary would be entitled to that initial $100,000 of corpus. Next slide. The will contain specific language if it's a testamentary trust. A testamentary trust is a trust that's created by the will. The specific language will provide for the creation of that trust upon the decedent's death. If the trust, however, is created during the grantor's lifetime, it's called an inter vivos trust. That's when the grantor would execute and fund a valid trust during his life. A living trust is a type of revocable trust whose terms will decide or determine how the decedent's assets will be distributed upon his death. Next slide, please. A pour-over will works with a living trust. Basically, any property that's held in the name of the decedent that has not been previously transferred to the trust would automatically transfer into the trust. The will have to still go through the probate process if the assets had not been previously transferred, but the assets will pass to the intended beneficiaries. It does not, however, apply to any jointly held assets or assets with the named beneficiaries. And basically the idea is to catch any property that's not transferred into the trust during the lifetime of the grantor.
And as Donna just mentioned, the pour-over will works with the revocable trust in that way. So anything that wasn't transferred during the grantor's lifetime into the trust will now be literally poured over into that trust upon their death. Upon the grantor's death, that revocable trust is now irrevocable because the person with the power to revoke it is no longer there. And just to give you an idea of why these would be popular, several reasons, which Donna's going to get into later, the pros and cons of revocable trusts. But they've always been popular in states that have an expensive and an onerous probate process, because putting it into the trust avoids having to deal with probate. Whereas if you have your assets governed by the will, you still have to deal with the probate process. So with a revocable trust, states like New York and Florida that have expensive and troublesome probate processes to deal with, revocable trusts have always been popular. What has made them now more popular in probably every state is that what we learned from the pandemic is that a lot of the probate, the surrogate courts, were closed. So if someone passed away and they didn't have a revocable trust, they had a will. Now they have an executor that needs to try to administer their estate, but they can't probate the will because the courts were locked down. And then even when they started being up and running again, there was a very, very long wait list to be able to have the probate taken care of. So now more and more people are using revocable trusts to avoid that problem should it ever happen again, so that they don't have to worry about the accessibility of getting to the probate court and having the administration start. Assets held in the revocable trust can be administered immediately after the person is passed by the trustee of the trust, and the probate process doesn't have to be dealt with. Thanks, Donna.
A credit shelter trust is a type of testamentary trust, one that's created by the will, and it's also known as a bypass trust. It's an estate planning device for married couples who want to take advantage of their combined exemptions. This is particularly useful for states that have either an estate tax and or an inheritance tax. And basically what this credit shelter trust does, it keeps the assets separate from the estate of the surviving spouse. There's also a Medicaid qualifying trust, which is a type of irrevocable trust, which holds assets so that it does not reduce the benefits from Medicaid. Next slide, please. Just some general trust rules. I had mentioned this before, but a trust is a separate legal entity. It's based on a fiduciary relationship between the various parties to that trust. A third party or the trustee, who will be designated by the trust agreement, holds the assets on behalf of the beneficiary or multiple beneficiaries under the terms of the trust agreement. In the case of a revocable trust, the same person can be the trustee and the beneficiary during the grantor's lifetime. A trust document itself is a legal contract, and it sets forth the powers of the grantor, the trustee, the duties of the trustee, who the beneficiaries of the trust are, how that trust will be funded. It also provides for the termination of the trust and the disposition of the trust assets. The termination can occur if either the trust provision specifies when that will happen, or if the trust agreement also specifies that the trustee has the discretion to terminate the trust. Next slide. A trust is formed under state law, and normally that's the state of the grantor, the grantor's resident state. It must have there must be a general intent to create this trust, and it must be for a lawful purpose. It can't do something that you wouldn't otherwise be allowed to do. The trust must be funded with assets. It must have assets. And as Christine mentioned before, it could be irrevocable or revocable. The difference is a revocable trust, once created, cannot be amended or modified or changed in any way from the grantor, by the grantor. The revocable trust is also known as a living trust, in which it can be changed by the grantor during his lifetime. It does become irrevocable once the grantor passes away. Next slide. I'm going to now talk about the advantages and disadvantages of both the irrevocable and the revocable trust. First, the irrevocable trust. What I've just said, if you remember, is that the assets no longer are owned by the grantor in an irrevocable trust. So therefore, the assets are protected from the creditors. The creditors of the grantor can't have access to those assets. It also shelters the assets from the limitations for government benefits, such as the case with a special needs trust. And the estate taxes can be minimized since the trust assets are separate from the grantor's estate. The disadvantages, however, is that the grantor no longer has those assets. He doesn't own them, they belong to the trust. The trust provisions cannot be changed by the grantor. There is a concept called known as decanting, or it's a modification of the trust, where the trust assets of one irrevocable trust are poured over into another irrevocable trust, but that's outside the scope of this presentation, and that's a limited exception. There are separate income tax filings for an irrevocable trust. Diane will get into those tax filing requirements later. And this is if the grantor trust does not meet certain requirements. If certain requirements are met, then there is no additional filing and the grantor can file them, can include them on his 1040, and we'll talk about those. Next slide, please. The advantages of a revocable trust: the grantor retains control of the assets, unlike the irrevocable trust. And he also has the control of the distribution of the property and the income. He can change it at any time, and it avoids probate for those assets held in the trust, which avoids the privacy since the probate proceedings are public. The disadvantages are that the assets are not protected by the creditor because the grantor retains control of them. The assets are deemed to still be owned by the grantor. There is that administrative burden, though, of retitling the assets to the trust. And there are no estate tax advantages. They will still be considered. Next slide, please. Now I'm going to make a distinction between a simple trust and a complex trust. Now, to determine whether a trust is simple or complex, it will be specified within the terms of the trust agreement. So for example, if the provisions of the trust agreement say that the income is required to be distributed to the beneficiaries at some time interval, which is at least annually, it will be a simple trust. So the simple trust is required to distribute all fiduciary accounting income to the beneficiaries at least annually. If the trustee makes principal distributions, that trust will then convert to a complex trust for that tax year. And a simple trust cannot make distributions to charities. Alternatively, complex trusts are ones in which the trustee has the discretion to distribute income or principal. The trustee can accumulate the fiduciary accounting income within the trust. The trustee may make discretionary distributions of either income or principal, and it may make distributions to charities. Next slide. A grantor trust is a type of trust in which the grantor retains certain powers. That causes the trust to be treated as owned by the grantor. Essentially, the trust is completely ignored for income tax purposes. That also means the grantor must report all the income, deductions, and credits. The income is taxed regardless of whether the grantor makes distributions to the beneficiaries. A grantor trust can also be revocable or irrevocable. An irrevocable grantor trust is sometimes referred to as an IDGIT or an intentionally defective grantor trust. And if it's irrevocable, the grantor still must pay the taxes due from his personal funds, not trust assets. Again, the terms of the trust agreement can provide provisions that allow for a reimbursement of those taxes to the grantor, but that would have to be specified within the trust document. Next slide. Because the grantor is responsible to report all the items of income and expense on his 1040, the tax rates that apply are those of the individual grantor, not the trust. As I mentioned before, also, there are specified provisions that cause the trust to be treated as a grantor trust. Right here, I have listed some examples. These aren't all of them, but some of them that will cause the grantor trust to be, the trust to be recognized as grantor trust. If the grantor has the ability to change or add beneficiaries, if the grantor has the ability to borrow funds from the trust without providing adequate security, if the grantor has the ability to pay life insurance premiums on either the life of the grantor or the grantor's spouse from the income of the trust, and the ability to substitute trust assets of equal value with different assets. An irrevocable grantor trust is structured specifically to remove the assets transferred to the trust from the grantor's estate, but still would be the cause for the grantor to be owned for income tax purposes. Assets that can be sold to the grantor trust without the recognition of capital gain. The grantor would essentially just be selling the assets to themselves. So that's why you wouldn't have to recognize that gain. Next slide, please. Another type of trust is a spousal lifetime access trust, or a SLAT. A SLAT is an irrevocable trust structured to provide the donor with limited indirect access via the beneficiary spouse, who is the beneficiary of the assets, to the trust assets. These type of trusts must be funded with assets solely owned by the donor. It can't be jointly held assets. Also, typically it's a grantor trust, so the donor would have to pay the income tax on any earnings. The non-donor spouse would be the beneficiary, but can also serve as the trustee. This property that's transferred is removed from the taxable estate of the donor and the non-donor spouse. One consideration is a disadvantage of this type of trust is that if the grantor and the non-donor spouse divorce, or if the non-donor spouse dies, the donor spouse will no longer have access to those trust assets.
Then Donna, if you don't mind, I'll jump in for a minute to say something about SLATs. These trusts have been around for a long time. They became much more popular back in 2012 when the exemption jumped up to, I think it was around 5 million. Now, with the incredibly high exemption that we currently have, for 2023, each individual has an estate tax exemption of $12,920,000. So this type of trust basically gives comfort to people if they want to fully utilize that exemption, because it is scheduled to sunset at the end of 2025. Beginning of 2026, it's supposed to drop down to around $6 million. So for taxpayers that have that much wealth and want to fully utilize the $12,920,000 before it's gone, they can use this type of trust with the comfort of knowing that there's that escape hatch or back door, in that they've set up a trust, say I'm the husband, set up a trust, wife and children are the beneficiaries. With having that spousal beneficiary, if something goes wrong, if circumstances change and now that 12 million or so that you gave away is something you need to have back, you can get it through distributions that come out to the spouse because the spouse is a beneficiary. So that provides a lot of comfort to people, because giving away that much is a concern. At any level of wealth, you would stop to think twice before you give away almost $13 million. But now, at least knowing that you've got that estate path in that back door, it gives comfort to a lot of people to use these slots as their planning tool to move the assets over, have them be for the benefit of the spouse and children, and it could also go on for grandchildren, etc. Get those assets and their appreciation in the future outside of your estate. It's a very popular tool. Many of them have been done in the last several years, and I'm sure we're going to see a lot more before the end of 2025 while we still have these high exemptions in place. Thanks, Donna.
Next slide, please. Two other types of trusts are a grantor retained annuity trust, or a GRAT, or a grantor retained unitrust, or a GRUT. A GRAT is an irrevocable trust in which the grantor receives the right to receive an annuity payment. These annuity payments are the only distributions that are going to be made by the trust. The payments are made at least annually and will continue for a specified amount of time or even at life. At the end of this fixed period, the remaining assets of the trust will pass to other named beneficiaries. A grantor retained unitrust is also an irrevocable trust, but the grantor retains the right to receive an amount which is determined each year as a fixed percentage of the fair market value of the trust assets. So it's also payable at least annually over some specified period of time or specified period of years of the lot. It could be paid at least annually for the life or the joint lives of two or more annuitants. Next slide, please. Another type of trust is a dynasty trust. A dynasty trust is specifically created so that wealth can pass from generation to generation. Theoretically speaking, if it's structured properly, a dynasty trust could last forever. Once it's funded, the assets and the appreciation of the assets will avoid estate and gift taxes and may be exempt from generation skipping taxes or GST. Can be a grantor or non-grantor trust, and it's irrevocable. The beneficiaries will not have the flexibility to alter the terms of the trust, even if their family or financial circumstances change in the future. One caution that has to be made with these dynasty trusts is that it has to be, care must be given so not to deplete the trust assets through distributions prematurely. Another concern is the passing of these interests in this dynasty trust can be limited by some states which have a rule against perpetuity. The rule against perpetuity is basically preventing people from using legal instruments to exert control or over ownership of property for a long period of time, or a period that extends beyond the lives of the people who were alive at the time the instrument was made. On the next slide, I'll show some examples of states and the particular provisions that have been adopted. Next slide, please. For example, the Connecticut Uniform Trust Code has adopted a law which allows dynasty trusts. So basically what they did was they extended the rule against perpetuities from 90 years to 800 years. New Jersey completely abolished its rule against perpetuities in 1999. New York, however, still is based on the common law rule, and the rule says that certain future interests must vest, if at all, within 21 years after the death of the last beneficiary alive at the time the interest was created. Only two other states have this rule, Alabama and Texas. Okay, next slide, please. There are two types of charitable trusts. Both types of trusts are split interest trusts, which have an income beneficiary and a remainder beneficiary. Both types of trusts must file a 5227 form. The two types are a charitable lead trust, which is a CLT, or a charitable remainder trust. The difference between the two is that with a charitable lead trust, the charity is the income beneficiary, whereas with the charitable remainder trust, the charity is the remainder beneficiary. And these also can last for a term of years or for life. A qualified personal residence trust holds either a primary residence or a vacation home. And what that does is that property will be removed from the estate of the grantor once the initial term is complete. There's no filing requirement either during the initial term of the trust. Next slide. There are also insurance trusts, which are also known as ILETs. ILETs can hold other assets other than insurance policies, but they're generally designed to keep that policy out of the estate of the grantor. These insurance trusts are irrevocable, and there's no filing requirement if the only asset of the trust is that insurance policy.
Hi, thanks, Donna. If you don't mind, I just want to say something about ILETs as well. They're a very useful tool, especially, and just to give an example, let's say you have an estate that has a lot of illiquid assets, somebody who's going to pass away with a lot of real estate in their hands, but they set up this ILET during their lifetime. So now the irrevocable life insurance trust owns the insurance policy. So with the trust ownership, it's outside of the decedent's estate. The value of that policy is not included in their taxable estate. The policy is now paid because the person's passed away, and now you have a nice lump sum of cash in the ILET. What can happen then is that with the estate having a lot of illiquid assets, if there's an estate tax liability or an estate tax due on that estate, rather than having to worry about a fire sale, having to sell off real estate that you wanted to stay in the family, the funds in the ILET can be used to pay the estate tax. They can either loan it to the estate or assets in the estate can be purchased. And now they go over to the trust and the cash comes into the estate. That's what makes these, one of the things that makes an ILET very popular is having that money there, but outside of the estate. It's not an estate taxable asset, but having it there available in the trust to come over into the estate and help with the estate tax liability and avoid a fire sale. And it's also a great idea to have a life insurance policy in a trust, just so that the value of the policy itself is not an estate taxable asset. With respect to the premiums, the money that gets contributed to the trust to pay the premiums on the policy, that gets more into gift taxes, and there's even some generation skipping tax concerns. We will be doing another webinar, as I'll mention again later in May, and we're going to be talking about gift taxes and generation skipping taxes in that webinar, and that's where we'll get more involved in that side of the trust that Donna's talking about right now. Thanks, Donna.
The final type of trust that I'm going to talk about is the Totten Trust. Totten trusts are used to pass money, not property or other assets, to a specified beneficiary, but there is a named beneficiary. These are also known as payable on death or transferable on death accounts. They're generally used for bank accounts. Again, it avoids the probate process. It's not a probate asset, and there's no separate filing requirement. So now I'm going to pass it over to Diane, who's going to start talking about the two different types of income that I mentioned before. Diane.
Thank you, Donna. So now that we have covered trust terminology, general trust rules, and several types of trusts, we will take a look at how trusts are taxed. Fiduciary accounting income versus taxable income. Trusts actually calculate two types of income. Each is used for a different purpose. Fiduciary accounting income, or FAI, is determined by the trust document and state law. It determines the amount which may be or should be distributed to the trust income beneficiaries. Since capital gains are generally considered principal and are added to the corpus of the trust, they are not income for this calculation. The disbursements or deductions of the trust will be allocated to principal and income. The allocation is based on a percentage and will result in some deductions not being fully deductible for FAI. We will get into more detail later as to what these percentages are and to which disbursements they are applied. Fiduciary taxable income is governed by federal and state income tax law. It is calculated in much the same way taxable income is for an individual. However, trusts are allowed an additional deduction based on distributions made to beneficiaries. It is the income distribution deduction. We will explain how this deduction is determined in a later slide. Next slide. Items that would be included in fiduciary accounting income would be interest, taxable and tax exempt, dividends, rents, royalties, and distributions of cash in the normal course of operations from pass-through entities, such as partnerships or LLCs. Next slide. Items that would be included in fiduciary accounting principle would be for testamentary trusts, assets received from the decedent's estate, contributions made to the trust, realized long-term and short-term capital gain, as well as capital gain distributions, return of capital, special or extraordinary dividends, and accumulated income not required to go to an income beneficiary. Accumulated income is income that has not been or may not be distributed to an income beneficiary. It is undistributed income. It will be taxed to the trust and is added to the trust principal. Next slide. Here we have an example of fiduciary accounting income using a complex trust. In this example, the trust receives income from various sources: investment income, which includes taxable and tax-exempt interest, dividends, and long-term capital gains. This trust also has rental and royalty income. In this example, the trust has just a few deductions: real estate taxes, trustee fees, and attorney accountant fees. Other expenses a trust could have are administration expenses and other taxes. The trust has total gross income of $40,000 and expenses of $7,000. Next slide. On this slide, we compare the calculation of fiduciary accounting income to taxable income. Looking at the two columns, we can see several differences. For income, taxable income does not include tax-exempt interest income. Fiduciary income does not include capital gains. Looking at expenses, we see for FAI, trustee and accountant fees are allocated to income at 50% as per the Uniform Principal and Income Act, which we will discuss in detail next. Certain deductible expenses for taxable income must be reduced for the portion that are allocable to the tax-exempt income. In this example, the tax-exempt income is 2.5% of the gross income, so the expenses are reduced in proportion. Lastly, the fiduciary deductions do not include the $100 exemption allowed for complex trusts. We did not include investment advisory fees in this example. For fiduciary accounting, they would be deducted per the Uniform Principal and Income Act, but would not be allowed for federal tax as a 2% deduction. This example also does not include the income distribution deduction, which we will go over on a later slide. Christine, was there anything you wanted to add here?
Sure, I just wanted to mention in your example where we mentioned this is a complex trust, if this were a simple trust, that $20,000 of FAI, fiduciary accounting income, would be the amount that must be distributed to the beneficiary or beneficiaries, because the language in a simple trust, as was mentioned earlier, states that the income must be distributed on an at least annual basis. So it's important when doing the tax return for a trust and even throughout the year, keeping track, not only just obviously your taxable income is the key on the tax return, what's going to be taxed, but your FAI, your fiduciary accounting income, is the trustee's guideline for what must actually be distributed. Because again, in a simple trust, that $20,000 would have to go out. More could, it would be fine if more was distributed. You can go in excess of FAI, but you'd want to make sure that the FAI at the very least was distributed. When we work on simple trust tax returns, we take a look to see, okay, what were the distributions during the year? How much is the FAI now that we know it because we're past the end of the year? Hindsight's always helpful. And then, okay, is there a difference? Like if 20,000 in this case was the FAI, and we saw distributions out to the beneficiary of 15,000 that took place during the year, we would have a cover letter going with that tax return to the trustee to say, FYI, the rules of the trust state, income must be distributed annually. Your FAI was 20, you made distributions of 15, please distribute another 5 to be in accordance with the trust document or the trust terms. So it's just important to, the distinction between the two is in a simple trust, that FAI is your minimum amount that must go out to the beneficiaries. Thanks, Diane.
Thank you, Christine. Next slide, please. So the Uniform Principal and Income Act, as seen in the previous example, expenses for FAI will be allocated to principal and income based on the Uniform Principal and Income Act. This act provides procedures to allocate receipts and disbursements to income and principal to arrive at fiduciary accounting income. The act was proposed by the Uniform Law Commission in an effort to make the laws of the various states more consistent. In general terms, a Principal and Income Act is a set of accounting rules to be used by trustees and other fiduciaries, such as estate executors, in allocating receipts and expenditures of the estate or trust between the entity's principal and income accounts. This accounting determines the amount distributable to an income beneficiary when the right of that beneficiary to receive distributions is based on the income of the estate or trust. Apportionment of a receipt to the income account will increase the amount distributable to the income beneficiary, but if it is apportioned to the principal account, it will not. Conversely, apportionment of an expense item to the income account will reduce distributions to the income beneficiary, while apportionment of that item to the principal account will not. Disbursements from income, as per the Act, are determined as half of the trustee's regular compensation and half of any fees for investment advisory or custodial services, half of expenses for accounting, judicial proceedings, or other matters that involve both the income and remainder interests. All other ordinary expenses incurred in connection with the administration, management, or preservation of trust, real and personal property, and the distribution of income is allocated 100% to income. Recurring premiums on insurance covering the loss of a corpus or the loss of income from a use of an asset is allocated to income. Next slide. The disbursements from principal would be the other half of the trustee's regular compensation and other half of any fees for investment advisory or custodial services, the other half of all expenses for accounting, judicial proceedings, or other matters, all of the trustee's commission calculated on corpus, principal payments made on trust debts, expenses of a proceeding that concerns primarily corpus, insurance premiums not allocated to income, state inheritance and other transfer taxes, including penalties apportioned to the trust, and disbursements related to environmental matters. Next slide. As mentioned previously, some states have modified the application of the UPIA. The principal and income laws of most states characterize these rules as defaults, which will apply unless and to the extent they are not overridden in the governing instrument. Some states have modified the percentages used in the application. Looking at Connecticut, New Jersey, and New York, we see that all allocate 100% of accounting and legal fees that are not incurred as part of a judicial proceeding to ordinary expense. Connecticut uses a 50% allocation for trustee regular compensation, investment advisory fees, and custodial fees. New Jersey differs in that it allocates trustee fees based on the amounts paid from income or principal and allocates investment advisory fees 100% to principal. New York uses an allocation of 1/3 expense and 2/3 principal for the different fees named above. Next slide. The concept of distributable net income and the income distribution deduction are a little complicated. Income distribution deduction reduces taxable income. It is calculated on Schedule B of the Form 1041. Distributable net income is the maximum amount that can be deducted to arrive at taxable income. The deduction is not unlimited. If the amount actually distributed or required to be distributed to the beneficiaries under the terms of the will, governing instrument, or state law as appropriate is less than D&I, the lesser amount will be the deduction allowed. If more, the deducted amount allowed is limited to D&I, and any distributions exceeding D&I are not deducted. Conversely, D&I is also the maximum amount of income that the beneficiary would have to report on their tax return. The character of the income which makes up D&I determines the character of the taxable income reported to the beneficiary. It is done as a pro rata share. For simple and complex trusts, this would be reported on a K-1. For grantor trusts, all of the income will pass through and is not limited by D&I. All of the income and deductions would be reported on a grantor letter. Next slide. This is an illustration of DNI. It is essentially a ceiling for the income distribution deduction, as well as a ceiling for the income being reported to the beneficiary. Next slide. Here we have an example of the DNI calculation using a simple trust. DNI begins with taxable income before the income distribution deduction. It is then adjusted for certain items as seen on the slide below. If there were no income or deduction from these sources, DNI would equal tax income before the income distribution deduction and exemption. These are the adjustments. The $300 exemption for a simple trust is added back. Tax exempt interest and dividends, net of any direct expenses, are also added back. We add back capital losses deducted to arrive at taxable income, unless they are included in any net capital gain required to be distributed. We subtract capital gains, again, unless they are allocated to income or directed to be distributed. Extraordinary or income dividends allocated to trust corpus are subtracted. Now, if we use the amounts from our previous example, we would arrive at a DNA amount of $18,100. We started with the taxable income of $32,000, to which we would add back the $100 exemption for a complex trust. And we would need to add the $1,000 of tax exempt income, which was not included. We would then subtract the $15,000 of capital gain. In that example, we had $20,000 of fiduciary income available to be distributed, but the deduction will be limited to the DNI amount of $18,100, or the actual required amount to be distributed, if less. In the case that this was the final year of the trust, all income, including capital gains and losses, would be passed out to the beneficiary, and DNI does not apply. Next slide. With DNI, there are certain special circumstances regarding the treatment of capital gains. There's an exception if the trust documents, state law, and some provisions under the Treasury regulations can allow for capital gains to be treated as income. And as noted on the previous slide, in the year of termination, capital gains and losses pass out to the beneficiaries. Next slide. General fiduciary tax rules. Income is taxed to either the trust or the beneficiary, unless it is a grant or trust. If income is accumulated, then the income is taxed to the trust. If income is distributed, then the trust gets an income tax deduction, as we discussed earlier, and beneficiaries report the income, unless, again, the trust is a grantor trust, in which case all income is reported by the grantor, regardless of distributions. Income is reported net of allocated expenses and will retain its characters as dividends, interest, rental income, etc. Trusts are generally required to use a calendar year. Permissible accounting methods include the cash method, accrual method, or any other IRS authorized method. Next slide. Now we get to the actual taxation of trusts. Trusts are separate taxable entities. They receive income, pay certain expenses, and are allowed certain credits. Simple and complex trusts are required to file a Form 1041 fiduciary income tax return and state fiduciary income tax returns, if applicable. Grantor trusts can be included on the grantor's individual return or file a separate return. We will look at the special filing requirements of grantor trusts later on in the presentation. As we have seen, taxable income is determined similar to that of individuals, but trusts are allowed an exemption depending on the type of trust. And that would be the $100 for a complex trust, $300 for a simple trust, and $4,700 for a qualified disability trust. Next slide. Again, as mentioned earlier, trusts are allowed a distribution deduction. The tax brackets for trusts are different from individuals and are compressed. Trusts are subject to estimated taxes and generally must make payments if it is expected to owe at least $1,000 in tax for 2023 after subtracting any withholding or credits. And to avoid estimated tax penalties, 90% of the tax expected to be shown on the current year return or 100% of the prior year tax must be paid. This increases to 110% if the trust AGI is more than $150,000. However, estimated tax payments for a current year would not be required from a domestic trust that had a full 12-month prior tax year and had no tax liability for that year. Next slide. Here we look at the trust tax brackets. Trust income tax is computed using a separate tax rate schedule with 4 tax brackets. In comparison to the tax rate schedule for individuals, it is less favorable as the top rate of 37% is reached at a much lower income amount. As we see here for 2023, this amount is $14,450. Next slide. We've included on this slide the tax brackets for individuals filing as married filing jointly. For these individuals, the top bracket is not reached until $693,750 of income for 2023. For complex trusts, this disparity in the tax rate should be considered when deciding how much income should be distributed. Next slide. Trusts also receive the long-term capital gains rate and qualified dividends rates. Income from long-term capital gains and qualified dividends that meet certain requirements receive a preferential rate. Here on the slide, we list those rates. Again, we can see there's a significant disparity between the level of income at which trusts reach certain rates as compared to the level at which an individual married filing jointly does. Trusts reach the 20% rate at just $14,650 versus that of a married filing jointly individual of $553,000. Next slide. Another tax imposed on trusts is the net investment income tax, or Medicare surtax. This 3.8% surtax is an addition to the income tax and is calculated on Form 8960. This tax took effect for individuals, trusts, and estates for tax years beginning on or after January 1st, 2013. Individuals married filing jointly will be affected if they have net investment income and their modified adjusted gross income exceeds $250,000 for 2023. The modification to AGI is for certain excluded foreign income. Next slide. Trusts and estates will be subject to the net investment income tax if they have undistributed net investment income, which means they did not distribute it out to the beneficiary. And they have adjusted gross income over the amount at which the highest tax bracket begins for the taxable year. Again, $14,450 for 2023. The following trust types are exempt from net investment income tax. Charitable trusts, retirement plan trusts, grantor trusts are disregarded for federal income tax purposes, and real estate investment trusts. Christine, before we move on, was there anything you wanted to add here?
Sure, I just wanted to comment, as Diane is highlighting the huge differences between the brackets of an individual versus a trust. The trust hits at around the $14,000 mark that she mentioned, the higher capital gains rate of 20%. It'll have the Medicare tax of 3.8% involved. It's also going to have the highest highest ordinary income tax rate for interest in ordinary dividends of 37%. So there's a planning opportunity that Diane's going to be discussing in a few more minutes called the 65-day distribution rule or distribution election. And this part of the presentation where she's talking about the disparity, you want to keep that in mind because that 65-day election gives us a hindsight planning tool. It's after the end of a tax year. We can look back and say, okay, now that we have all the information because we're past December 31st, what was the income and the deductions of the trust? What's the taxable income of the trust going to be? And see how much of a tax hit the trust will be having. And then make the decision, do we want to make some distributions out to the beneficiaries to pull this income over to their lower income tax brackets, assuming they're in a lower bracket? And those distributions made in that 65-day period can be applied back to the prior year. But these disparities that Diane just went over, and how quickly a trust hits the higher rates and the higher capital gain rate and the Medicare surtax, as opposed to individual brackets, is the reason why that 65-day election is so helpful. Thanks, Diane.
Thank you, Christine. Next slide, please. These are some of the examples of income that are considered net investment income. Next slide. Income tax filing requirements for trusts. A trust is required to file Form 1041, U.S. income tax return for estate and trusts, for each taxable year in which the trust has any taxable income, $600 or more of gross income, regardless of taxable income, a beneficiary who's a non-resident alien, and if the trust held a qualified investment in a qualified opportunity fund at any time during the year. Trusts are also required to issue a Schedule K-1 to the trust beneficiaries reporting the amounts distributed to them from the trust. The beneficiaries must report these amounts on their Form 1040. I'd like to note that the due date for 2022 Form 1041 this year is Tuesday, April 18th. This is because April 15th falls on a Saturday. Emancipation Day, which is a federal holiday, falls on the 16th, a Sunday, and it will be observed on Monday, the 17th. Keep in mind that not all states will follow the federal due date. Connecticut, New Jersey, and New York do. Now, the extended due date of September 30th also falls on a Saturday this year, and this will cause the due date to be Monday, October 2nd. Remember, this is an extension to file the return, but not to pay any tax due. A payment must be made with the extension on April 18th. Next slide. As mentioned, there were special rules for grantor trusts. If a grantor trust uses the grantor's Social Security number as its taxpayer identification number, and all income is reported to it, it does not need to file Form 1041. If the grantor trust has its own taxpayer identification number, it will be required to file a Form 1041. However, the income and deductions will be reported on a grantor letter attached to the form, which is issued to the grantor. Some states, such as Pennsylvania, do not recognize grantor trust status and require trust income tax return to be filed with the tax paid by the trust or beneficiaries as applicable. Next slide. This is just a quick example of a very simple grantor letter. Next slide. 65-day rule, which is also known as the 663B election, is an effective hindsight tax planning tool for complex trusts and estates, as Christine mentioned. If these distributions are not made during the tax year, the 65-day rule may remedy any deficiency or can be used as a tax planning item. This is an election that can be made by the fiduciary of an estate or a complex trust. Under the 65-day rule, a trust can make distributions to the beneficiaries within 65 days after the end of the tax year and treat those distributions as if they were made in the previous tax year. For 2022, any distributions made on or before March 6, 2023 are available for this election. The election amount, however, is limited to the greater the trust fiduciary accounting income or distributable net income. The balance of distributions made within the 65-day window, which are not needed or allowed for the election, will be utilized in the year of distribution. It allows the trustee to shift some of the income to the beneficiaries of the trust, who may be taxed at lower tax rate than the trust. The election is made by including those distributions on Form 1041, which must be timely filed, including extensions. And once made, the election is irrevocable for that year. It is an annual election. This concludes my portion of the presentation, and I will pass it over to Christine.
Great. Thanks so much, Donna and Diane. It was a great presentation. We've been answering a lot of the questions during the course of the presentation. I do see another one. I believe this is for Donna. Is it possible for a trust to have more than one trustee? And I'm sorry, we'll give Donna a moment for her camera to power up.
Yeah. I can answer it while my camera is still working. Yes, a trust can have multiple trustees. They'll be referred to as co-trustees. Sometimes this makes it a little bit more administratively difficult since more than one person has the ability to make decisions, but the trust document can indicate more than one trustee.
Exactly. And even in addition to, you could have people operating as co-trustees, you could have successor trustees, and you should in the trust document. So if something should happen to the trustee you initially named, or they've resigned, you've got your backup plan in place. And just something to keep in mind, and this was mentioned during the webinar, that the location, the residence of your trustee is important to consider when you're choosing one. Because just to give an example, you could have a New Jersey trust, and then you choose a trustee who happens to live in, let's say, California. The state of California now will be taxing that trust because they have a trustee who resides there. So that's something else for income tax purposes to take into account when you're choosing your trustee or trustees, is where they reside, because you want to watch out for the states that would then pull your trust into that state because of that trustee residence. I also wanted to mention before we concluded, we are going to be doing a webinar in May. We have not fixed the exact date yet, but you will be getting an invitation. It'll be advertised probably late spring. Well, actually, I should say probably around April or so. They'll start sending out emails for that. We're going to be going over gift taxes and generation skipping transfer taxes, focusing more on the GST side of things. So whereas today we talked about trusts and the types of trusts and the mechanics of them, the presentation in May is going to talk about the transfers into them, the actual transfer tax consequences of funding trusts. We'll be covering that in that webinar. And we've answered, as I think I mentioned before, we answered a lot of your questions during the course of the webinar. I did see quite a few people asked if the webinar will be available afterwards. It will be posted on our website this afternoon. It's www.pkfod.com, and it'll be in our Insights section. You'd also asked if the slides are available, and Harleen, I'm going to kick that to you. Are the slides available on the website as well?
Yes, the slides will be available on the website as well.
Oh, fantastic. Okay, then with that, we'll wrap up our side of it. And I think, Harleen, you had some closing comments to make.
I did, Christine. Thank you, Christine. Thank you to our speakers, and thank you everyone for attending. Please remember to complete the short survey prompted at the close of this webinar. A recording and PowerPoint will be made to attendees via email within the next few hours, and as Christine said, it will be available on our Insights page of our website, pkfod.com. Thank you again, and have a great rest of your day.
Thanks, everybody.
Thank you.